Hey traders, Jason here from Leavitt Brothers. Lots of stuff going on in the market, lots of volatility, big moves in both directions. The bears are currently in control, so day to day the movement will be much bigger than what we've become accustomed to. That's just the current state of things. Instead of a mixture of up and down days with very few days posting a big gain or loss, we're still getting a mixture of up and down days, but the movement is much greater. Let's take a look under the hood today. Oftentimes the indexes mask what's really going on, so I want to run through the S&P select groups. Okay, the S&P breaks the market down into sectors and groups, which at any time, could either be doing worse than what the indexes are doing, or better, or they can just confirm what the indexes are doing and tell us the market is doing exactly the way it should. So these are the S&P select groups: energy, utilities, materials, industrials, consumer staples, tech, consumer discretionary, healthcare, financials. I'm going to go through each one of these groups, daily charts, weekly charts, to try and figure out if we get any hints or any clues. Maybe there's like strength somewhere, or maybe everything's weak and the indexes are doing exactly the way they should. So that's the goal here, is to go through these and to try and figure out if there's some sort of hint going on, beneath the surface. All right, so here is my TC2000 software. Okay, weekly charts on the left, daily charts on the right. That's what I'm going to do for each one of these groups. I'm just going to run through them. Okay, and I'm going to run through them in no particular order. All right, so here's materials. So obviously you have. Okay, so we have, so longer term chart, you have the 50 was taken out, a trend line resistance or support was taken out. Okay, so the group has clearly broken down. Now it's down near its 200 week moving average. This obviously shows up on the daily chart. The top was back in January, February, moved down sideways. Now it's moving down with force. Not much to really like long term. I could see that if it's not going to work. All right, so I could see if this thing, if we bounce here, we're probably going to get rejected because we have all this resistance over here. We have the 50-week moving average, which is rolling over and going to move down. So even if we get a bounce here, it's probably going to get rejected, come back down and at least test the low before it could actually sustain a move up. And this process of up, down, up, if that's the best case scenario, that could take several months to play out, even into 2019. So this group is just dead money for a while. There's no reason to be long the group unless you're a short-term trader and you just want to play these pops. But overall, there's nothing to play here if you're long. And as far as what it hints about the economy, this is the materials group. It has to do with housing and building and such. So it doesn't imply really good things that the group isn't doing well. All right, next chart. Here is XLE, energy. Energy is a tough one to figure out. Okay, so if I look at this, energy is flat over the last couple of years. Energy is hard to figure out because you want energy to be doing well, but you don't want it to be doing too well. And then even at that, you don't know what it implies. Okay, so if it's doing well, maybe that means demand is strong, the economy is strong, but you don't want it to do so well that it actually chokes off growth, because the higher energy costs could do that. But then again, if it's doing well, what does that imply about inflation or deflation? So it's a hard group to figure out. It's a hard group to kind of read the tea leaves and try and figure out what it implies about the economy. So I'm just going to take it at face value. If we come over here to the daily chart, you can obviously see this is moving down. Where's my sorry about that. Just trying to get my tickers right, or my tools right. All right, so you can obviously see it's moving down. Again, not trying to read anything about the economy, just the fact that it's moving down. There are a lot of energy stocks in the S&P 500, S&P 400, S&P 600, and if this is moving down, then obviously those stocks are moving down, which means the market's going to have a harder time moving up. That's all I'm going to read into this. I'm not going to read into like whether the economy is strong or weak. I'm just going to read into the fact that we just took out a support level. It looks like it's going towards the bottom of its range, and this is going to weigh on the market because there are a lot of energy stocks out there. All right, so financials. Here we have weekly on the left, big topping pattern. We just took out like a support level here. Okay. And to me, this is a warning. It's kind of a big warning, because if interest rates are moving up, then the financials should be able to do really well. And the fact that they're not doing that well is somewhat telling. It tells me that they're not able to loan out money. They're not able to make money. There's something going on there, because they should, if they did well when interest rates were low, then they should be doing even better when interest rates move up, but they're not. So this tells me there's something wrong with the market, and I don't think it's a good thing. Okay, so this is a, I don't want to say financials are a growth company, but they should definitely, not a growth company, a growth group, but they definitely should be moving along with the economy. If the economy is doing well, financials will do well, and vice versa. And the fact that the financials just broke down to basically a 52-week low doesn't imply good things about the overall economy and market. All right, here is industrials. Overall doing fine in the near term. Obviously, it's taken a big dump lately. Okay, so we have like a support resistance here on the weekly, resistance up here. So it's a big consolidation pattern that goes back 12 months. Overall, not bad, but if this thing bounces, it's probably going to get rejected by its 50-week moving average here, and then who knows? We'll see if it breaks down or if it could like pause here and go through it. So I consider it neutral, which it has been over the last year. It's just traded flat. It's not hinting at anything, but we'll see what happens here. It's right down near support. It's right in the middle of its 50 and 200 week moving averages. If it moves up and gets rejected, then who knows? We could drop all the way back down to like the 200 week moving average down here, and of course that wouldn't be good for the overall market. All right, tech overall not bad. It's sitting down near its 50-week moving average, so it's not doing great in the near term, but it isn't bad. It's holding up better than most of the other groups. Over here on the daily, you have the 200-week moving average. It's sitting right below it. Certainly that's salvageable. So you can see this area here. But from here, we're building resistance levels overhead. So if this thing bounces, it's probably going to get rejected by the 200 or by the 50-day moving average. Because oftentimes, like the first time it gets rejected. If you look back over here where it moved down, then it moved up. It took it out briefly, but then it got rejected and moved back down, and then a second attempt it moved up. So from here, odds favor this thing getting rejected. Okay, over here it didn't. It moved down and then moved up, but then still came down to test it. So I don't think it's going to be, even if the market's in good shape, I don't think this thing is just going to go straight up. Even if it went straight up, it's going to probably have to come back down and test. It could also get rejected and then just come back down and do a double bottom and then try up again. Either case, enough damage has been done that the market's not going to just recover. Okay, it's not going to just go straight up. It's going to take some time, whether it needs to go up, get rejected and come back down, or whether it goes through it, comes back down and tests it, and confirms that that's solid support and then goes up. Either way, this is a process that could take a couple months to play out, and could take all the way into 2019 to for us to get some sort of resolution. So tech's not doing horrible, but it's not doing great, and there's resistance levels above to deal with. Consumer staples, if you look at the weekly, going back a couple years, we're flat. If you look at the daily here in the near term, things obviously doing much better. Okay, so we have resistance level now. It's being taken out today. So I guess there's a hint here that money is flowing into consumer staples. Companies like Procter & Gamble, companies that make toilet paper and toothpaste and stuff. This is the group that's doing well. It's on the daily chart. It's above its 50 and 200. On the weekly chart, it's above its 50 and 200. So money is rotating out of financials, a little bit out of tech, a little bit out of industrials, out of energy, and they're coming into to consumer staples. So there's some appetite for some safety out there. You can see the scale over here on the right side, 52, 53, 54. So even a big move for this is only a couple percent. And it looks like that's what investors are looking for right now. Okay, here's utilities. It looks very similar in the near term to consumer staples. You see long term here, it's been trending up nicely. 200-month moving average has supported the stock several times going back a couple of years. If you zoom in over here with the with the daily chart, you have a resistance level here that was just, it's being taken out right now today. So same thing, just like consumer staples, there's an appetite for some safety here. And again, you look at the scale here, 51, 52, 53. A bad month for utilities is dropping like 2, 3, 4%, whereas a bad month for tech, you could drop 2, 3, 4% in a single day. So there's definitely rotation of money out of some of the riskier growth-oriented sectors into safety of the utilities. Here's healthcare, overall doing great. Okay, we had you can see like a pause here on the weekly, broke out, came up, came back down and tested, came up again. So overall doing well. If you look over here at the daily, it's come down hard from its high. It's now going to have to contend with all this resistance above. We have the 50-day up here that's going to, trading in the middle of the 250, it's always a kind of a tricky part because you move up, you can get rejected, you move down, you can get supported. So right now I consider it neutral, maybe leaning down. Even if you get a bounce, it's going to have to prove itself. It probably is going to, if it does this, it's probably going to get rejected by the 50 on the first attempt. It's going to either do a double bottom and then go up, or do a double bottom and continue down and maybe meet the 200 over here. So overall it's doing okay, but in the near term it's not that attractive. I'm certainly not going to just blindly try and buy one of these bottoms. You can see the bottom over here and over here. It takes a while to form a bottom. You can see this like big up down up pattern, and then it formed consolidate here, and then it moves up, consolidates, and still has to test. I mean, it was a 3, 4, 5 month process. Once damage is done, it's like a multi-month process to right itself before it moves up. So to expect this just to go back up to the high, it's probably not going to happen. All right, one more chart. XLY is the consumer discretionary group, doing really well. Near term, you could see support level taken out, 50-day moving average taken out. Now it's below its 200-day moving average. So overall, it's doing fine. But in the near term, it doesn't look very attractive. And just like the rest of the groups, if this thing moves up, you can get rejected by the 200, or it can come up here, get rejected by the 50, have to come back down, do some sort of retest. It could take out the low, it could successfully test the low, and then probably move up from there. So if it's in the cards to improve, to move up, it's probably going to take some sort of up-down action in order for all that stuff to play out. All right, let me remove this from my screen now. All right, why isn't this? All right, I'm trying to remove this thing from my screen, but it's just not working, so that's okay. So I'll just continue on here. I only had one more slide to show anyways. So overall, I don't really like what I see. Okay, the best groups in the near term are utilities, consumer staples, healthcare is holding up okay. Otherwise, everything else is below their 50 and 200-day moving averages, and they have lots of overhead resistance to contend with. Okay, so even if they bounce, they're going to have to contend with these levels. If the market was holding on to some strength or building strength, you'd see tech doing better. You'd see financials holding up. Energy would be doing better. But I don't see any of this. I don't see money. I see money coming out of growth-oriented stuff and moving into safer, less volatile groups. Okay, so what does this imply about the market? The market is not in great shape near term. A lot of technical damage has been done, and it'll take some time for the market to right itself. Okay, if that's what it intends on doing anyways. Okay, so even if we do get a bounce soon, which we probably will, the biggest updates occur within downtrends. Okay, so they're going to happen. These groups tell us that the bounce won't go too far or last very long. Okay, some repairs, technical damage has been done, and some repairs need to be done, and that'll take some time. Okay, again, thanks for listening. If you like the video and want me to do more, give it a like, share it with your trading friends. You can also subscribe to the channel right here on YouTube. Come check us out at Leavitt Brothers, where we provide trading ideas, market analysis to independent traders, funds, and financial advisors. Again, thanks for listening, and I'll see you next time.